Welcome to the debate. Today, we're staring down the barrel of a market environment that seems specifically designed to test the resolve of even the most seasoned capital allocators. We are looking at a pretty brutal confluence of factors right now. On one side, we have intensifying geopolitical tension, specifically, the friction between the United States and Iran, which is sending these massive shockwaves through risk assets. And on the other, we have a cryptocurrency market that, by almost every metric, appears to be running on fumes.
Yeah, it really does. It feels like the air has just been completely sucked out of the room. We have asset classes behaving in totally contradictory ways, and the signal-to-noise ratio is arguably at its lowest point in this entire cycle. I mean, you have Bitcoin acting as this sort of safe haven, while literally everything else is just gasping for air.
Precisely. And that brings us to the specific sector we really need to dissect today. We aren't talking about Bitcoin. We are talking about the Total 3. Now, for those who aren't glued to TradingView all day, the Total 3 is the index representing the entire cryptocurrency market cap, but excluding Bitcoin, Ethereum, and stablecoins.
Right, it's the altcoin market.
Exactly. It is the absolute purest measure of speculative appetite. And my thesis today is that we are not merely in some temporary pause. We are in a bad range characterized by a severe global liquidity contraction. So the central question we are debating is this. Is this current downturn a clear signal to exit and wait for a wealth check, a significant drop to retest lower structural levels? Or is the resilience we are seeing in very specific assets a sign that the worst is already priced in?
It's the classic dilemma, right? The falling knife versus the train leaving the station. You believe the data points to a highly defensive posture, basically a retreat to cash until valuations reset to what you consider fair. I, however, see the potential for a very different outcome. While the liquidity picture is undeniably tight, I argue that strict adherence to these lower targets often leads to missed opportunities in the strongest protocols. You really risk waiting for a price that the market is just too smart to give you.
Well, I represent the position that capital preservation is paramount during a contraction. The charts absolutely demand patience right now, and cash is a valid position.
And I represent the view that market structure is always forward-looking. The strongest assets, the true winners of this cycle, they're likely being accumulated right now in the shadows while the crowd is fearful.
Let's begin with the reality of the situation. I am looking at the Total 3 chart, and I see a market that is undeniably heavy. We are not in a phase of expansion. We are in a phase of contraction. My position is that, sure, the market does not fall forever, but we are currently trapped in a defined downward trend driven by a global drying up of liquidity.
Look, the trend is down, I grant you that, but trend is not destiny.
But evidence is evidence. I mean, look at the divergence. This is the absolute smoking gun for me. Bitcoin managed to secure new highs recently. It did its job. But what did the altcoin market do? It failed. It completely failed to follow the leader. That is a massive bearish divergence. We have a specific technical signal on the weekly time frame that is just impossible to ignore. The market swept a previous high, grabbed that liquidity, and then closed red.
Yeah, the sweep and reject.
Textbook sweep and reject pattern. It signals continuation to the downside. My analysis suggests a drop of approximately 23% from recent levels. We're looking at a return to the 2024 lows, which is around a $312 billion valuation for the index, or perhaps even deeper into that wealth check zone of $260 billion. To buy now is frankly to fight the tide.
I appreciate the technical rigor there, and I don't dispute that the weekly candle looks ugly. It does. However, my issue lies with the absolute certainty of that 23% figure. You are basing a massive strategic withdrawal, selling assets, creating tax events, moving everything to stables, on the assumption that the market will just move in a straight line to fill a gap on a chart.
It is about probability, not certainty. And right now, the probability heavily favors gravity.
But markets are mechanisms of anticipation. We know that interest rates are projected to eventually drop. We are looking at liquidity expansion potentially returning around the Bitcoin halving cycle or rate shifts in 2027. And the market often bottoms long before those conditions officially change. If you sit on your hands waiting for the total 3 to hit exactly 260 billion, you are betting that no one else is smart enough to front-run that level. You're betting that the smart money isn't already accumulating the assets that are showing strength.
And that right there brings us to the core of the disagreement. Let's dissect the macro framework. You talk about anticipation, but we need to talk about the why. Why are altcoins bleeding? It's the risk curve. Money flows into risky assets, and let's be very clear, altcoins are the riskiest of the risky. Only when money flows freely in the broader economy, when the spigot is open.
Right. And right now, the spigot is tight.
Exactly. When rates are high, and when you add the catalyst of the US-Iran conflict, capital flees to safety. It goes to the dollar, it goes to gold, maybe it goes to Bitcoin. It does not go to some speculative protocol ranked number 400. The statistical probability of altcoins outperforming in a liquidity contraction is negligible. This is a purely risk-off environment. Investors retreat to safety. The logic is simple. The market contracts until the macroeconomic environment pivots back to expansion, which is likely not until 2027 or 2028. Buying before that pivot is gambling on a premature reversal.
See, I come at it from a completely different way. You say gambling, but I call it positioning. If we accept that the expansion is coming, that the liquidity spigot will turn back on in 2027, then the accumulation phase has to happen during the contraction. That is the paradox of investing. You have to buy when it feels wrong. The boring phase, this choppy, sideways to down action, is completely necessary to set up the expansion. My argument is that if you wait for the expansion phase to be confirmed on the charts, you're buying the top. You are buying after the massive move has already happened.
I am not suggesting buying the top. I am suggesting buying the bottom. And we are just not there yet.
But there is a moving target. The market is efficient enough to know that rates will fall. We are seeing real resilience in assets like Solana and BNB despite the macro headwinds. That tells me that the market is already pricing in the future recovery. If you wait for the mainstream headlines to say liquidity is back, the price of Solana won't be where it is today. It's going to be double.
Let's test that hypothesis against the technical analysis of the total 3 then. You mentioned efficiency, but I see structural gaps. We really need to talk about fair value gaps.
Okay, for the benefit of the listeners, let's define exactly what that means in this specific context. Fair enough. A fair value gap, or FVG, is essentially a void in price action. It happens when price moves so aggressively in one direction that it leaves a pocket of inefficiency, basically orders that were never filled. The market has a very strong magnetic tendency to revisit these zones to fill them. It's like a vacuum that needs to be sealed. Right now, looking at the total 3, we have a clear target at 357 billion. Below that, the 2024 low at 312 billion. And then the level I find most compelling, the wealth check at 260 billion.
Wealth check is a pretty dramatic term for a retest. It is a highly accurate term. It represents a retest of broken structures that haven't been revisited yet. It filters out the tourists. It wipes out the over-leveraged longs who were impatient. If the total 3 index drops to 260 billion, that is where the opportunity becomes truly asymmetric. That is where risk is minimized. Why on earth would I allocate capital now, knowing these magnets exist right below price?
Because technical targets are not physical laws. They are psychological zones, and the psychology of a wealth check is tricky. Everyone sees that 260 billion level. You see it, I see it, Twitter sees it. When a target is that obvious, the market has a nasty habit of front-running it. Maybe we stop at 280 billion, maybe 290. If your strategy is totally binary like, I buy at 260 or I hold cash, you risk being left behind entirely.
Then I miss the trade. Rule number 1 of survival in this market. I would rather miss a trade than lose capital.
Or are you just losing purchasing power in an asset class that moves exponentially? The nuance here is that while the average altcoin might drop 23%, the specific assets you actually want to own might not. You are applying a broad market index analysis to highly specific idiosyncratic assets.
I disagree with that characterization. The correlation in crypto is incredibly high. When the tide goes out, all boats lower. But this actually segues perfectly into our next point, asset selection strategy. Even if I were to concede that some buying is warranted here, the criteria must be incredibly strict. We need to apply a mathematical filter. You take an asset's price and divide it by the total 3 index.
The relative strength ratio?
Exactly. It removes all the market noise. If that chart is bearish, meaning if the asset is trending down against the index itself, it is dead weight. It is statistically underperforming a market that is already dropping. Why would you hold that? Look at Render or EGLD.
Both fundamentally strong projects with real-world utility, though.
Fundamentally, perhaps, but technically, they are bleeding against the average. The data shows they have underperformed the total 3. They are weaker than the market. Holding them is an opportunity cost nightmare.
I understand the math, but I really question the extrapolation there.
Let me finish the thought. Conversely, look at the winners: Solana, BNB, BGB, which is the BitGet token, Tau. These assets have either made new highs or have mathematically outperformed the general altcoin market during this contraction. Even newer entrants like Hyperliquid or established DeFi protocols like Aave. This is where the smart money is hiding. My strategy is simple. Cash is king until the total 3 hits its target downside, and then you deploy only into these relative strength leaders.
That is a compelling argument, but have you considered the concept of rotation? You are assuming that past performance during contraction guarantees future performance during expansion. You look at EGLD or Render and say, they are weak, discard them. But historically, crypto markets rotate violently. Just because an asset underperformed during the bear market, does that guarantee it won't rally the absolute hardest when liquidity finally returns?
It doesn't guarantee it, no, but betting on it is illogical. It is betting on a horse with a broken leg just because you think it might heal faster than the stallion that is already running ahead.
Is it? Or is it just value investing? If a project is fundamentally sound but technically lagging, it might offer a much better risk-reward ratio than buying Solana, which is already hovering near highs relative to the rest of the market. You are effectively momentum trading on a macro time frame. I am asking if there is room for mean reversion.
Momentum is the only truth in a liquidity drought. The market is telling you exactly what it values. It values Solana. It values BNB. It values Hyperliquid. It does not value the laggards. To bet on a rotation into weakness during a liquidity crisis is to bet directly against the flow of capital. Look at XRP or TRX. Even they have shown specific types of resilience that the laggards haven't. The market has made its choice.
I suppose my concern is that by focusing only on the assets at all-time highs or near them, you're chasing. You're buying the assets that have already moved.
I am buying strength, and I'm buying that strength at a discount, provided we get the drop I am predicting, which brings us perfectly to the specific buying opportunities. I am not suggesting buying Solana here at these prices. I am waiting for the fair value gap on Solana's chart to fill. We have identified much lower levels for Solana that align with the broader market drop.
And that is exactly the point where I think your strategy becomes fragile. You want the strongest asset, Solana, to drop back into a deep value gap while simultaneously outperforming the market.
It is entirely possible. If the total 3 drops 23%, Solana can drop 15% and still technically outperform.
But if Solana is the chosen asset of this cycle, as your own relative strength metric suggests, it might just refuse to fill that gap. It might consolidate sideways while the rest of the market bleeds. It might never give you that entry.
Then let's look at XRP. The charts point to a wealth check level at 93 cents, or a deeper gap fill at 63 cents. These are concrete numbers based on actual market structure. Or Aave, it is currently at the bottom of its range. These are the zones where a disciplined investor strikes.
Buying Aave at the bottom of the range is reasonable. That is a defined risk. But waiting for XRP to go all the way back to 63 cents, that feels like greed disguised as patience. If the market turns on a dime, say geopolitical tensions ease overnight, or a central bank makes a dovish comment, those orders at 63 cents will never be filled. You'll just be watching from the sidelines.
And if the market collapses because we are in a bad range, buying at current levels will feel like pure recklessness. The weekly candle on the total 3 explicitly signals a drop. The target is the 2024 low. The prudent move is to set the buy orders at the deep discount levels, the 312 billion or 260 billion mark for the index, and just wait.
There is one other asset you mentioned that I think really challenges your contraction thesis, and that is Tau. It represents the AI sector. It has rallied significantly. It is a very high beta asset. If liquidity is truly contracting as hard as you say, why is a high-risk AI token performing so well?
Because it is a narrative play. Narratives can briefly defy gravity, but gravity eventually wins out. Even Tau has fair value gaps lower down. My argument remains consistent. You can like the asset, but completely hate the price. The goal is to acquire the winners, Tau, Solana, BNB, but to acquire them when the market capitulates, not when it is just hovering in no man's land.
No man's land is simply the space where accumulation happens for those who don't need perfect entries. I look at BGB and BNB exchange tokens. They have performed exceptionally well. Why? Because the utility is constant. The market trusts them. Waiting for a massive crash in BNB might be waiting for a black swan that just never arrives.
Or it is waiting for the inevitable cycle of liquidity. We know the timeline. We are looking at rate cuts and true expansion as a 2027 story. We are in 2026. We have time. There is no rush to be fully allocated today.
Time is a luxury, but timing is a trap. If you fundamentally believe in the 2027 expansion, you should be building positions right now, accepting the volatility. The 23% drop you fear is just noise in the context of a multi-year cycle.
A 23% drop in the index can translate to a 40 or 50% drop in individual altcoins. That is not noise. That is capital destruction.
For the weak assets, yes. But for the strong ones you identified, likely much less.
Which is exactly why we filter. But we must also respect the macro gravity. The wealth check is necessary. The market structures that have been broken to the upside need to be retested. It is healthy. It filters out the leverage. It resets the funding rates. I want to buy when there is blood in the streets, even if it is just a technical correction.
And I want to ensure I actually have a ticket for the ride. I worry that your pursuit of the perfect fair value entry ignores the messy reality of a bull market forming in the shadows.
We really have to talk about the boring phase. The boring phase is where most retail investors lose their money. They get chopped up trying to trade it.
Or it is where they lose their position. The boring phase is a psychological filter. The price action is designed to be uninspiring. It chops sideways, it dips, it rallies a little bit and then fails. It is specifically designed to make you lose interest. If you are waiting for excitement to buy, you are late. The accumulation happens when it is boring. If you can survive the boredom and the bad range, as you call it, you are perfectly positioned for the expansion.
I see why you think that, but let me give you a different perspective on these so-called bull markets in the shadows. A bull market built on contracting liquidity is a castle built on sand. Real, sustainable expansion requires the central banks. Until they move, we are just trading ranges. And right now, we are at the top of a range looking down.
Or we are at the beginning of a massive decoupling, where crypto acts as a hedge against the very geopolitical instability you cited earlier. But I digress.
Well, we can agree on the asset class, at least. We both see the undeniable value in Solana, BNB, Tau, and Aave.
Yes, the selection is not the primary disagreement here. It is entirely the execution.
Precisely. To summarize my stance, the data is bearish. The weekly candle sweep is a massive warning shot. The liquidity contraction is the fundamental reality of our current macro environment. My advice is to respect the 23% downside risk. Cash is a valid position. Wait for the total 3 to hit 312 billion, or ideally 260 billion. Watch for the strongest assets, the ones that held up the best, to dip into their fair value gaps and then strike. That is how you outperform.
And my summary is this. The contraction is temporary and likely already priced in by the smartest actors in the room. While a drop is certainly possible, rigid adherence to lower targets is dangerous in a forward-looking market. The best assets, Solana, BGB, the AI sector, might not offer the deep discounts you're waiting for. If you believe in the 2027-2028 expansion, the risk of being completely out of the market is greater than the risk of a temporary drawdown. Accumulate the winners, ignore the noise, and don't let a 20% potential drop scare you out of a 200% potential gain.
A 200% gain is wonderful, provided you don't lose 50% first. But I suppose this is the nature of the beast?
Indeed it is.
The boring phase of contraction is really where the psychological battle is fought.
It is. The cycle of contraction is completely necessary to set up the expansion. Whether you choose to catch the falling knife at the wealth check zones or accumulate through the pain is a decision every investor must make for themselves.
The only certainty is that the cycle will turn. The question is just where you will be standing when it does.
That is a question we will leave for our listeners to answer. Thank you for listening to The Debate.